Welcome to I Thrive Ideas. Today we're going to talk about inherited IRAs. An inherited individual retirement account is established for the beneficiary of a deceased owner's retirement plan, whether it be an IRA or an employer plan such as a 401k. Depending on the relationship of the beneficiary and the deceased IRA account owner, there's a couple different options when deciding how to manage the inherited asset. There are three types of beneficiaries: a spouse beneficiary, a non-spouse beneficiary, and a non-person beneficiary. A spouse beneficiary is self-explanatory. A non-spouse would be a sibling, child, grandchild, relative, or friend. And a non-person would be a family trust, estate, or a charity. There are a few options on what to do with the inherited asset once received. Today we're going to discuss non-spouse beneficiary options. If you are a non-spouse beneficiary of the deceased owner's IRA, you can either take a full lump sum distribution, take distributions utilizing the 5-year rule, or take distributions over your life expectancy. The first option of taking a full distribution would be liquidating the asset and taking the fair market value in cash. In most situations, IRAs are 100% taxable, meaning the beneficiary will pay income tax on the full amount of the distribution in that year. Depending on the amount of the distribution, this could put you in a higher tax bracket and leave you with a hefty tax bill in April. The second option is utilizing the 5-year rule. This option is only available if the deceased account owner passed before reaching 70 and a half and did not start taking required minimum distributions. This option allows you to take distributions however you'd like without penalty, so long as all the assets are completely distributed from your inherited IRA by December 31st of the 5th year following the IRA owner's death. So why would someone choose this? Well, it allows you to delay or escalate distributions in a given year for tax purposes. For example, if you had a high income year and knew the following year was going to be dramatically lower, then you could postpone your distribution to the following year. The third option would be to take distributions over your lifetime. When you transfer assets from a traditional IRA into an inherited IRA, there are required minimum distribution rules to follow set by the IRS. This means you need to withdraw a certain amount of money from your inherited IRA each year based on your age and life expectancy. In the case of a non-spouse beneficiary, required minimum distributions are generally required to begin in the year after the year of death. And these rules require that you withdraw the full required minimum distribution amount each year required. The required minimum distribution for your inherited IRA will be calculated using your age in the year following the year of death and based on an IRS single life expectancy table. By only taking the required minimum distribution, the remaining balance can take advantage of tax-deferred growth. Please note that if you fail to take your required minimum distribution in a given year, you could face up to a 50% penalty of that amount. So make sure you fully understand the options and have a plan. It is important to consult with a tax advisor and financial planner on the specific tax implications of each one of these options before making any big decisions. We hope that you enjoyed this video, and as always, please feel to reach out with any questions you might have. Thank you.